This is this is Hans Augustine in New Jersey. Thank you for taking the time this evening. If you got invited to this call tonight, that means you are getting access to great information. And one of the reasons why I say that is because right now in America, financial literacy is the key conversation to how we can help individuals actually open a door of potential success. And when we say success, we're not just talking about monetary success. We are literally also talking about the success of great information because what we realize is that as long as the information is missing, then there's a misunderstanding on the opportunities that actually could be applied to any individual that is willing to make a decision on how to what we call build wealth. So I'm going to share my slide with you guys today. If you've never met me before, as I mentioned, my name is Hans Augustine. I'm actually one of the business directors for our Infinite company. And here at our organization, what we really try to do is concentrate on the concepts of financial literacy. And part of the concepts of financial literacy is beginning to leverage what I call understanding so that you can make a very clear decision about what is possible. And what is possible is the ability to leverage wealth as your first form of understanding. Now, why am I saying that now as one of your first form of understanding? Because there are three ways in America to earn or to develop a cash flow or make money, or there's three forms of money that people should get very comfortable in understanding. So, in order for me to talk about the wealth building strategy, I want you to become clear that there are three forms of money that matter to your understanding because this presentation is going to be tied to learning how to leverage wealth, the comparisons of leveraging an index universal life strategy versus a real estate strategy, or how to possibly combine them. But the reason why I've been sharing with people that you want to understand the three forms of money is because you need money in order to build wealth. So the very first money that you should be aware of is that most likely if you have a W-2 position, if you have a job, that's fine. That is one of the sources of money that you will have access to in America. The second form of money that you shall have access to in America is generally through the process of running a business. If you learn how to run a business, that means you're bringing in business income minus the expenses that you have in that business. If the business income is better, then you're going to make a profit. That means you're going to have a little bit more left over. And then now you understand that there's a possibility of building wealth because wealth is a strategic idea that you're going to take your income from your job, the money from your profits, and you're going to put it in a place that can make you more money without you having to be part of that conversation. So, the reason why I'm going to share with you guys the wealth strategy is there's an objective here. The objective here is to kind of show you the pros and cons of building wealth through real estate versus an index universal life policy. A index universal life policy, all it really is a contract. It's a life insurance contract that has these key benefits. And I'm going to show you those key benefits. Some of the key questions that I'll answer to you tonight is what are some of the challenges of real estate investing that I've learned over the course of the time that I've done it consistently? How does an IUL potentially offer a better cash flow solution? Because the reason why we started talking about money at the very beginning of the call is because once you begin to understand that money is also tied to cash flow, how do you bring it in? How do you have access to it? And I'm going to show you how to complement this solution or possibly replace it from a real estate strategy into understanding how you can put this into a wealth building strategy. So now the first part is that we do have to understand how real estate really works for a lot of folks who do it. So if you're a realtor on the line, happy to have you. If you're somebody that has exposure to owning real estate, that's actually great. So you're going to understand these components of the conversation. The components of the conversation says that if you are doing real estate investing, most likely the way that you've learned it or been exposed to it is that somebody said, "Hey, if I could teach you how to purchase a property, then I can teach you how to hold that property, and you're going to be able to generate what we call money." And that money is called rental income, or that money is called the appreciation, the equity that you can earn over the course of time. And probably equity and rental income is probably the two most common statements that people can end up making about leveraging this as a financial strategy. So now, leverage also means that in order for most investors or anybody who's interested in buying property, most likely they're going to have to go borrow some money from a bank. So the loans represent that you're going to go get a mortgage because for every property that you buy, you have to potentially expand it. And in order to expand, you're going to have to borrow the bank's money. And that's how most people get more property over the course of time. Now, the strategies that people use in the real estate game is obviously buy and hold, as we mentioned. They buy a one family and they can rent it out. They can buy a two family, three family. Some people call them triplexes, quads, whatever the word in your local real estate community. Those properties are going to be bought so that people can hold them for a period of time. Time could be 2 years, 3 years, 5, 6, 7 years. And during that 5 to 6, 7, or 10, 20, 30 years, they're collecting rental income and they're creating an appreciation of value. And that appreciation of value is how you're going to make more money. And they call it equity. Or sometimes people may identify a piece of property that's in a great neighborhood, has a lot of potential, but because of over the years damage, or maybe, the property hasn't been kept, they are going to convert that property by fixing it, and they intend to flip it in a short period of time. That means anywhere from 6 months from the time that they bought it, maybe a year on average, they are going to repair the property. They're going to make it beautiful, new windows, new roof, and they're going to sell it for the appreciated value. And so in the real estate space, the way that you increase your wealth is by getting more cash flow or increasing the value. So when I did it, I loved short-term rentals, still do them till this day. It's another way for you to monetize the piece of property that you control or own. And you can control short-term rentals in the form of a lease. You can control short-term rentals in the form of converting the units in your property that you own to not only create appreciation, but you can create rental income. And short-term rentals, all it really is the ability for you to leverage somebody that might use Airbnb, VRBO, some of these vacation slash short-term rental sites where you can have a guest stay with you for different visit reasons, from work to vacation. And you guys might be familiar with a Airbnb particular, but the other part is commercial property in the real estate world. That means somebody is going to leverage some sort of other business like a laundromat, a dry cleaning, a childcare center. Typically, those locations are not owned by the business owner, but the business owner needs a location. He wants to make it affordable. And some business owners might even buy the commercial property and they rent it out to somebody else. But the reason why I started to understand that, based on my experience of being a realtor, based on my experience of going through the background of learning how to invest through others or starting to shadow certain deals and learning how to implement, I realized that this is a great strategy. But every time you have a responsibility to make more money, it means that you're acquiring more responsibility. And that responsibility became certain challenges and risks that people have to understand is a reality in managing real estate specifically. So if you're buying a piece of property, you most likely are going to put out some sort of down payment require. Interestingly enough, for the first time home buyer who plans to live in that property, their down payment requirements can be a little bit more conservative. But if you're an investor, there's a good chance that most banks that are going to offer you a loan says, "Hey, Hans, I need you to put a down payment on this deal." And it could be anywhere from 20 to 30% of the value of the house or the purchase price. So let's say I'm buying a house for $100,000. That means even then, unlike a traditional buyer who might put 5, 10%, if I have to put 30% down, that's 30 grand of money that I got to have in the deal. So that means I'm leveraging the risk of borrowing more money from the bank, and I'm also leveraging my own money. But one of the other things that I realized as you start to do more real estate, depending on the time of which you purchase this property, you'll quickly realize that there are things called market volatility. It just means that in a certain environment, depending on the timing or the conditions of the market, property values can lose or start to decline, which means that if you bought a property for $100,000, but now it's now worth $90,000, you just lost $10,000 worth of value. So the other part is that you might love the property market and things are going well. You're okay with the risk. One of the things that you have to manage is tenant and maintenance issues that can begin to arise in the process. So that means late payments, property damage, potential high risk costs that are tied to major events. The other thing that I started to measure was how liquid can you get into a property. I was talking to a client today and we were doing our needs analysis. And one of the things that he did was he owned a lot of real estate. And he says, well, what's my concern? I said, well, you have a liquidity challenge. And he says, what does that mean? I said, well, you have a lot of property that you own free and clear, but the only way you can access that money is in the form of a refinance or a sale event. And if your credit is not sharp, then you may not be able to access the money and you may not want to sell the property. So depending on how you understand real estate, there are some strategic things like credit that you should have access to very fundamentally always, tax implications that you got to make sure you know are going to be true, meaning as you buy property and you manage it on a yearly basis or a monthly basis, there are property taxes that are due. If you sell, there's capital gains. It just means that you're going to be taxed on the value of money that you've created, and there's potential depreciation recapture, which is another strategic way to understand the tax implications of a real estate strategy. So today's not a real estate class, but I just want you to understand that there are things like time management realities that now impact how you make a decision about these types of solutions and strategies. Now, I love me some real estate. I don't want to make it up and saying something wrong, but I tell you that I begin to understand why I got excited about understanding what my other options are. One of the other things that I ran into the real estate space was that as you acquired a mortgage, there's two components of a mortgage that everybody should always be aware of, because these two components will give you an understanding, does this investment make sense depending on how long you plan to access or leverage a mortgage, because a mortgage has a interest volume game tied to it. It's literally the finance fees that you will pay to the bank over the course of time called interest, because it's literally money that you're handing over to the bank on a monthly basis. And I'm going to show you the amortization schedule, or there's a factor in finance called loss opportunity cost, which only basically means that if I put $30,000 in this deal, where could I put $30,000 somewhere else in order to increase the value of those dollars? So when you're making strategic decisions, the reason why there is potentially a leak in your equity in the mortgage debt that you're tied to, because the amortization schedule is highly built in favor of the bank. So that means that if you understand that a $1,600 10 payment is positioned for you to make that monthly, that's completely fine. That means you got a great payment on a $300,000 mortgage at a 5% interest. But here's where the math matters. In the interest category of that $1,610, you are literally paying $1,250 on average in the form of interest to the bank. It will start to decrease, meaning that by $1 or $2 per month, but that is a slow moving amortization schedule, because if you did a quick comparison, the only amount that's going to the principal amount is about $300. So out of the $1,610, you want to begin to understand that there's a lot of money. So even on average, 78% of the money that you might be making in a mortgage payment is headed over to the bank in interest. So when we talk about finances and the ability to understand literacy, what we're really saying is that, hey, run the math. Now, I didn't know how to do that prior, not because I wasn't a smart guy. I didn't understand the psychology of how money works in certain transactions. So one of the reasons why I had to become very clear about my strategic understanding on how I could leverage my dollars, I had to understand the transactions that were tied to it. So now, here's what's important. As I begin to study how money works, I wanted to understand better options on how to build my wealth. So if you went around the world and you said, hey, what are my better options? you'll find out that there are many people across the United States using wealth building alternatives in different forms. And one of the wealth building alternatives that you have access to in America is called an index universal life strategy. And so now I'm going to explain this kind of step by step, just for your own understanding and component of what's really happening in this transaction. But I want you to understand this one thing. Here's how it's going to go. In a index universal life insurance policy, there is a permanent life insurance section in that policy. This is the life insurance deal in this transaction. So let me see if I can get my pencil again. Hopefully that works. So there's a permanent insurance feature in this contract. That is the life insurance portion. But the thing that I fell in love with is that in that account, there's something called cash value, and you can learn how to accumulate money in these accounts. Through the accumulation of money, what you're really doing is that you're positioning your dollars to earn more money because now it can earn interest. And what it's doing is in these accounts, especially the financial institution that we use, they leverage the S&P 500. What does the S&P 500 mean? It means the top 500 companies in the United States are being used to measure how interest is going to be applied to that account. And what that means is these are the Googles, the Microsofts of these worlds that are part of the measurement of how you can make more money in a cash value structure. The other reason why this is a great wealth building alternative is because you can create a tax-free withdrawal or a tax-free distribution of income. Understand how you can leverage, understanding how to leverage loans in this space. Now, the reason why this got my attention, everybody, is because now when I begin to understand what I really had access to, I begin to realize that there was a great opportunity here. The opportunity was that I can create what I call different forms of income distribution in this transaction. And if I can do it tax-free, I basically am doing the very same thing that I would need to do in a particular real estate transaction, which was the reason why I went to go look for the deal, the reason why I was interested in buying the properties, because ultimately I was trying to create more cash flow. But if you could take a contract or if you could leverage a life insurance policy that has the ability to earn interest, create income distribution, and leverage different forms of cash flow, just like a rental income, it's maybe something that I thought I should take into consideration. And it's something that I happily share with others, understanding that there are benefits tied to this particular strategy. The benefits are, hey, I don't like dying, but if I did, then there's a death benefit that I can pay out to my family in the form of a life insurance policy. But guess what? I'm not interested in dying, but if I didn't, now I can take advantage of building the value of my money and I can have different forms of protection. The forms of protection is that, hey, based on the structure of these contracts, you can create market participation. The participation is the money that you are growing in that account to participate in the market, growing more money and interest, but there's a downside protection part. The downside protection says that, hey, based on a zero floor strategy, worst case scenario, you won't lose the dollars that you put in the account outside of the actual cost of insurance. And because I can create a tax advantage, leveraging this one rule, if you go home tonight, you want to look up the IRS code 7702. That is the IRS code that allows us to understand that this contract can be created in a tax advantage way, sort of a tax shelter that allows you to leverage the true rule of a life insurance policy to create values of cash, along with leveraging all the other benefits that are tied to these accounts. Now, as I begin to understand that, I was able to do a quick, easy comparison. Now, if I'm buying real estate today, I'm going to have to put some sort of initial investment in the deal. And I would say that depending on where you live in the United States, in New Jersey, there's a high-end price point now in real estate. So if I had to buy a property for $500,000, $500,000, and I'm an investor, that means I have a responsibility, generally a minimum of 20% of my money in down payment. Now, the reason why this is important is because You remember when we started to contrast and compare, I mean, contrast and compare, what are we contrasting and comparing is saying, hey, what if I put $100,000 in this real estate deal that requires me 20%? What would have been my other alternative options? Because we just talked about lost opportunity cost, and we understand that there might be other wealth building alternatives. Well, in the real estate deal, I got to put $100,000 of my own money, then I still got to go borrow some money from a bank. And I'm at risk for the loan responsibility at the bank. But that's how real estate works across the United States and America. But here's where financial literacy comes into place. Financial literacy comes into place, says now I can make choices on what to do with my $100,000 because I now strategically understand. Let's say I go the real estate route. Maybe the real estate deal could end up being better if you ran the numbers, but as long as you understand the literacy component of everything, now you can make a better decision because maybe in this deal, I'm going to bring $24,000 of income per year. I'm going to have some expenses. Let's say it's 50% of that. That means I'm going to net about $1,000 per month in this deal, right? I can't do the pen yet because I don't have my mouse, but you guys get my point, right? But then I still have to take care of the market risks that are tied to making a decision in owning real estate. I have to be very clear about the taxation, and then I got to go understand what my liquidity components, meaning that in a real estate deal, in order for you to access the money, you got to go borrow more money from a bank or you have to be able to sell it. And those are the only two choices. Now, there are benefits in understanding how that works, but what if you did the same thing? If you took the same $100,000, you would not only save time, but you don't have to go borrow any money from a bank. You don't have to worry about that ugly amortization schedule that can be tied to any real estate transaction or mortgage debt. But if you are competing for factors, you say, hey, I can now create what I call cash value growth, and I can create an income distribution. That means you have options. And if the market risk says that there are no market losses because there's a guaranteed floor, now you reduce your risk even further. But the other reason why this has become exciting to talk about is because, well, taxation is part of the real estate conversation. There's ways maybe to go around it and leverage it in your benefit. But I can create income distribution in an IUL environment and automatically create a tax-free situation. So as I begin to study the components of leveraging cash value and creating liquidity immediately, meaning that one of the benefits of leveraging a cash value account is that you can get access to the money in a short period of time after you've had some value built into these accounts. So the reason why you want to do a contrast is compare is I begin to real estate as I understand the components and my experience in real estate. I begin to leverage and understand that there are other wealth building alternatives and specifically leveraging the concept of an index universal life. So the thing that we have to become clear about in building wealth is all tied to cash flow. The ability to make more money, but in an IUL environment is I can create a tax-free situation. I can position myself for no market losses. I can leverage it just like real estate, which means that based on the value of my accounts, I can borrow money against that account, creating investment and personal uses. And then what I love is the self-sufficiency. Self-sufficiency is tied to the idea that you can create your own banking system. Now, if you can create your own banking system, you now have access to money. Instead of borrowing money from the bank, you borrow the money from yourself. Because what you're really doing is you're keeping the money in house. Every time you have access to your paycheck, you have access to a business profit. If you can circulate the money in your wealth environment 2 or 3 times, then you are creating value because if it's leaving the household, it's going over to somebody else. So here, leveraging the wealth concept of leveraging an IUL, you can create passive sources of income, and you could leverage this towards even a conversation of retirement, depending on when you plan to use it. As I begin to understand that I could overcome certain real estate challenges, the IUL became very clear to me that there were less liquidity challenges, less risk, more tax efficiency, more long-term security, and the ability to create a plan, especially tied to someone's estate. The ability to transfer assets in an immediacy is tied to the idea of leveraging a life insurance contract, and you can skip the traditional steps that might have to go through when it comes to real estate called probate. So once you begin to understand the math, you now know that there are two options that you have. Option one is I still love real estate. I want to go in this direction. Option two is I can perform the same acts of a real estate transaction, but leveraging an IUL or a life insurance contract to do it. But what if you decided to combine both? This is where it got my attention. See, once you have knowledge to how something works, it doesn't mean it doesn't work. It just means you can improve it. I improved the concept by leveraging the structure of an IUL, the framework of a real estate deal to create what I call the ultimate strategy, which means that I can use the IUL to fund my real estate investment in the form of loans instead of getting a mortgage. Because when I get a mortgage, the money is going out to somebody else. When I borrow my own money, I'm circulating my money back to me or back to a growing environment so that I can take advantage of that money in the future, along with the fact that in these combined features, you can create a tax-free retirement fund along the side, the cash flow of a real estate deal. Now you're creating a legacy strategy. I want you guys to understand that the power behind leveraging money where you can access it becomes extremely powerful. Here's point number one. I helped somebody from a case study standpoint and say, hey, you're age 35. He has access to $500,000. He says, what can I do with it to grow it and access it? I said, well, perfect. The best two questions you've asked me. Well, what I can do is I can help you create a distribution of putting money into this account, but giving you a time value of $93,000 of that money available to potentially be used in the future or currently, but we're also giving you a death benefit of $2.2 million. He says, well, I don't anticipate to die. I don't anticipate for you to die neither. But if you did die, wouldn't it be great to give your family $2 million worth of tax-free money? See, I was talking to a gentleman today. If you understand how money works, it's a generational thing if you position it correctly. The thing with this case study was saying, hey, well, he says, how do I get access to this? Well, let's say you're in the fourth year and you needed access to $100,000 to go do more transactions. Your account would have grown to a certain amount of money, and now you can access that money. And you don't even need to create a loan payment immediately. We recommend highly that you begin to put the money back, but now you understand what your choices and options are. So if somebody invited you tonight, I want you to understand that everyone should have this conversation. We've just noticed that a lot of real estate investors are attracted to this. We've noticed a lot of business owners and high income earners and retirement savers are trying to understand what to do with their dollars, accessing opportunity. So tonight you got invited to understand the opportunity that's at hand. And let's have a conversation, because if these are some of the folks that you are, or the people that are around you, we now have a way to help. So when we sit down with you, what we do is we go through a strategic process of helping you build what we call the ultimate wealth building strategy. We want to teach you how to create a secure cash flow strategy. And this is a no-cost session, which means that the person who invited you as a guest says, hey, let's get back and have a conversation to understand what your choices and options are so we can improve the value of your dollars or improve the value of creating wealth. So tonight, I thank everybody for taking the time to participate in the process of learning, or if you got invited by someone to be here to kind of learn and leverage this opportunity, we thank you. I appreciate your time, Ms. Beck, Ms. Amanda, Ms. Marlene, for those who've been able to attend the call. As we start to do this consistently, we want you to be comfortable inviting peers, friends, and people who strategically want to leverage an understanding of how to access a great strategy. You guys have a great Thursday night. Look forward to connecting with you this week next Thursday. For those that may have some questions, I'm going to open up the line and stop sharing my screen to make sure before we wrap up if there's any questions in the community of those that attended tonight, so that we can make sure that we can get you a couple of answers before we wrap up. So any questions tonight for anybody that's attended so far and before we wrap up this evening?
No, Hans, but appreciate the information.
Oh, no problem. I appreciate it, Miss Amanda. I will definitely get connected with you guys. If you have any questions, we'll see you tomorrow morning. And you guys have a great evening. And thank you for taking the time for learning, actually. All right. Good night, everybody.